Afternoon, good evening to all of you. Thank you for attending the fourth of our webinars around the COVID theme, and hope all of you are well and your families continue to be safe. As some of you may have heard, my view of the crisis is that we're going to go through three stages. There's a health crisis stage, there's an economic crisis, and lastly, there's going to be a social crisis. And here at Digilytics, we've been working a lot, and we work a lot with AI technology to provide easy-to-use products, primarily for the mortgages and secured lending industry. And our last three webinars have been focused on the impact the crisis is having on technology and on the secured lending space. But as we slowly but surely recover and move out of the health crisis phase, I think it is important for all of us to address the looming economic and social crisis. And we today cast our eyes through the looking glass to look at some of the macroeconomic learnings from previous crises and how they may impact us and affect us over the next 2 to 5 years. And in order to do that, we have an extremely high-powered panel of macroeconomists. And we are very fortunate that to moderate the discussion, we have Professor Vijay Narayanan, who is the Thomas D. Waverly Professor of Business Administration at the Harvard Business School. Welcome, Vijay. And without much further ado, I'm going to hand over to you.
Thank you, Arindam. So let me introduce the three panelists first. Amit Gupta is a current fellow at Stanford University's Distinguished Career Institute, undergoing his renaissance in multidisciplinary education across humanities, AI, and the creative arts. His traditional education was at IIT Bombay and IIM Ahmedabad. He has 25 years experience in the financial services industry across Asia. His last corporate assignment was as the CEO of HSBC Private Bank in Singapore. Prior to that, he was treasurer and managing director of HSBC Global Markets in Singapore through the 2008-2009 global financial crisis. Amit was an economist for HSBC India in their Mumbai dealing room during the 1997 Asian financial crisis. He's an advisor to Digilytics and Nadatur Estates. He blogs on AmitSecondChance.com. Our second panelist is Michael Klein. He's the William L. Clayton Professor of International Economics Affairs at the Fletcher School, Tufts University, and Research Associate at NBER. He's the founder and executive editor of EconoFact, a non-partisan digital publication launched in January 2017 to present analysis of timely economic policy issues. He served as chief economist in the Office of International Affairs at the United States Treasury from June 2010 to December 2011. Our third panelist is Kaushik Rudra. Kaushik leads the rates and credit research teams globally at Standard Chartered. He is based in Singapore. His teams leverage the bank's strong on-the-ground presence in all of its key markets to produce highly differentiated transaction-oriented research. The credit and rates research teams have strong followings and have ranked consistently highly in their respective categories. Kaushik has over 25 years of experience in emerging markets, having covered Latin America, EMEA, and Asia from New York, London, and Singapore before joining Standard Chartered in 2008. Kaushik worked at, joining Standard Chartered in 2008, Kaushik worked at Lehman Brothers and Morgan Stanley, where he was responsible for global EM strategy. Previously, he was an economist with World Bank in Washington. He holds an MBA in finance from the Stern School of Business, NYU, and master's degrees in international finance from Georgetown University and economics from Delhi School of Economics. So welcome to all three panelists. I want to start with Professor Michael Klein. I was hoping that you could take us back in time and talk about both the Great Depression and the Great Recession and sort of set the table for us as an introduction to the current crisis.
Thanks very much, Vijay. It's a pleasure to be with you this morning. What we've seen over the last 14 weeks or so is really unprecedented. And the roots of it are different from what we saw in the 1930s and in 2008 with the Great Recession. Yet those episodes give us some guidance as to what to do now. Although, as I'll mention, I think it's also of limited appeal because there are also important differences. What we have now is both a demand shock and a supply shock. That is, the supply shock is that people can't go to work in a lot of places because of the what some people call the Great Lockdown. I would call it the Great Shutdown. The difference between a lockdown and a shutdown is a lockdown is mandated and a shutdown is the choice of people. And what we've seen in the United States is that there have been restrictions and regulations, but people are choosing on their own not to work, not to shop, not to go out. And evidence of that is that in states where there was not an official lockdown, the unemployment rate rose by about as much as in states where there was, in fact, where there were regulations to do that. Along with this is a demand shock. A lot of people have lost their income, and in that way they can't afford to buy things that they would like to buy, so the economy shrinks as a consequence of that. How is this like what we saw in, say, the Great Depression in the 1930s or in 2008 with the financial crisis? The Great Depression, as most of you probably know, began with the October 1929 stock market crash, and then the financial seizing up that followed that. By 1933, about almost 4 years later, the unemployment rate in the United States had reached 25%. A very important part of the collapse of the economy had to do with the collapse of the financial system, that banks were bankrupt, that people were taking money out of banks. That contributed to the monetary policy shock. Furthermore, the government, the fiscal authorities did not, before Roosevelt, follow a pattern that we would recognize today as helpful. The idea was that, in the words of the Treasury Secretary at the time, Mellon, we should liquidate, liquidate, liquidate. The idea was that the economy would like go through its rot and then emerge stronger. But of course, it took more than 10 years for the economy to recover. The lessons of the Great Depression were not lost upon economists, and that led to what is called the Keynesian revolution in economics, where there was seen to be a much more important role for the government to engage in the economy, especially at the time of deep weakness. What happened in 2008 then was that when the economy started to fail after Lehman Brothers, because again, a seizing up of the financial system, the Federal Reserve and the Treasury moved in very quickly to try to support financial markets. And after some initial hesitation in the United States, the government, and other countries as well, the government stepped in with fiscal stimulus. One of the sort of interesting side points of this is that the chairman of the Federal Reserve at that time, Ben Bernanke, was widely recognized as the greatest student of economic history of the Great Depression. So he very strongly took into account the lessons of that time and saw how important it was to save financial markets. As he would say, we're saving Wall Street to save Main Street. And it was sort of a necessary part of the response. Today, however, things are really quite different. There is a financial component to this because, for example, we saw in the municipal bonds market, the market was seizing up, but the Federal Reserve stepped in to try to provide liquidity, and that brought down the spreads in that market. There are concerns about non-performing loans at banks, which could impair banks. But again, the Federal Reserve is stepping in to help. And we do see a fiscal response, although at this time, I would characterize the fiscal response as more of a lifeline than a stimulus, because if people can't go out and spend, you're not going to generate a lot of stimulus in the economy. Instead, what you're doing is helping people who have very little savings, who couldn't make the rent, who couldn't pay their mortgages, who might not even be able to feed their families at this time. So while some elements of what's going on today is similar to what we saw in the early 1930s, and in 2008, 2009, there is this important distinction. I would just close with two notes. One is that there's tremendous uncertainty right now about what will happen. And there are two sources of that uncertainty. One, obviously, is the virus itself. In the United States, we're starting to see spikes in incidences of the virus in states that had opened up, primarily in the South and in the Southwest. And so we don't really know how the virus is going to proceed. And because of that, we don't know what the economic consequences will be. Another important point at this time is that the unemployment rate reached about 14 or 15%. We don't know what's going to happen in the future. It could go higher. While this is not the 25% of the Great Depression, it's the highest we've seen since then. What economists call scarring from this could be very dramatic. That is, what we could have is a series of bankruptcies. So unlike a short V-shaped recession like what we saw in the United States in 1982, after a severe downturn, there was a recovery, and the companies and businesses and restaurants and so on were there to rehire their workers once the economy picked up again. Now, because this has been so precipitous and so large, and there's so much uncertainty, there's going to be, I would guess, a large wave of bankruptcies. So the second element is, to what extent will the economic scarring, the fact that businesses go out of business and it's not easy to restart, will that prevent companies or people coming out of the recession finding places to rehire them? So the main point I would make is that there's tremendous uncertainty now. Lessons from the past offer some guidance, but this is in many ways very different from the very severe recessions we've seen over the last 100 years.
Thank you, Michael. Let me go now to Kaushik. Can you walk us through what it felt like in the Great Recession in 2008, particularly in emerging markets, and give us, having lived through that, what are the parallels that you see? What are the differences that you see?
Sure. I mean, I think, obviously, I was at Lehman at that time, so saw it very up close and personal from what happened. Obviously, financial markets seized up. We've seen a transformation since then in terms of how financial markets have operated, how liquidity has been treated, how regulators have played a much more important role in the financial sector. So a lot has changed. But what I would say is back in 2008, 2009, it was primarily what I would describe as a developed market crisis rather than EM crisis. I think emerging markets, by and large, were in much better shape back in 2008, 2009. And I think the difference now is that leverage has picked up. I mean, we've had 10 years of very low interest rates. Emerging markets has, countries have borrowed a lot, corporates have borrowed a lot, so leverage has definitely picked up. And going into this crisis, if you looked at growth around the world, particularly in emerging markets, whether it's China, whether it's India, whether it's other parts of the world, growth was actually fairly anemic. So going into this crisis, EM was not in great shape. And I think this time, the financing side of things is probably going to be a lot more impactful for large parts of emerging markets, which will really struggle to raise capital, raise funding. And I think that's going to be a big challenge for emerging market countries. But I think 2008, 2009 was clearly a watershed event. In developed markets, there was a lot more leverage at that time. And I think we saw that obviously come down, and that had a profound impact on how banks were shaped, how regulators got involved, and a lot obviously changed since then. This is a very favorite topic. I can keep going on, but probably in the interest of time, I'll keep it short. Maybe we can dive into this more in an interactive way in sort of the Q&A.
Okay. Let me turn now to Amit. Can you bring us the perspective? We talked about the macroeconomy and the trends, but give us the perspective of a lender, of a financial institution. You had, ringside seats to the financial crisis in 2008 and even the 1997 crisis, Asian crisis. What was it like then? How does this current crisis feel? Is it similar, different from a lender's perspective?
Sure. Thanks, Professor. Yeah, I think I'd agree with Professor Michael when he said this one is unprecedented in a lot of ways. There are similarities, and specifically for, I guess, the banking sector or the financial sector. Let me just think back of the 2008 and 9, and because the epicenter was the US, it was a housing, or the roots of the crisis were the housing mortgage, and it was the banking sector. It was both the solvency of the banking sector as well as the liquidity, which was the focus for the policy response of the Federal Reserve and the Treasury. I would disagree a little bit with Professor Michael when he says that they were very quick to have a response. I guess I was a market participant as a banker in Asia, and I thought the US, there were several hits and misses. It took them a little bit of time to socialize an effective intervention mechanism, the TARP. It took almost 5 or 6 months between Lehman in September and March 2009 when markets got the confidence. And I think lenders and financial institutions got the confidence that the precipice was or had been avoided, while of course statements were made as early as September and October. And TARP was actually passed as a law in October, TARP being the Troubled Asset Relief Program. But the actual confidence that markets got was subsequently much later. And the difference really was in terms of, while there was a monetary stimulus and a fiscal stimulus, the liquidity was not really reaching Main Street. And that was, I think, the big challenge, the way we saw it from Asia. And the reason was that in some ways the US was a bit narrow in their policy response because, as I said, they were focused on the epicenter being New York itself. The response in Asia by the regulators, the way we saw it, was much broader. And one of the things they did was directed lending to banks, to the real economy, both to large corporates and to SMEs. And that we saw in China, we saw that in Singapore and Hong Kong, in ASEAN. And I think directed lending as opposed to market led capital allocation and liquidity were the two distinct differences between EM and DM anyway. And as Kaushik said, I think emerging markets were, it was a DM crisis at that stage. So it's a bit unfair to say it was, the money was not reaching the real borrowers of the liquidity. But I think this time around, we have seen a difference. We've seen, personally, I think that the ability of the US to learn from that crisis has been phenomenal. They've been very quick. The size of the monetary stimulus, $3 trillion initially, announced within weeks in early March this year itself, has been significant. And again, there have been very specific programs that the Federal Reserve has had, which are linked to directed lending, not dissimilar to the ones which we saw in Asia earlier. And importantly, for critical market functioning, they have had programs. And last, very importantly, they have managed to infuse confidence in the markets, if you like. And let me just give you a quote from the March 23rd statement of the Federal Reserve. And it's a very simple quote, but it says, the Federal Reserve is committed to using its full range of tools to support households, businesses, and the US economy overall in this challenging challenging time. And then there was sweeping new measures for large and small businesses, an unlimited bond buying program. They were buying corporate bonds for the first time in history. And therefore, liquidity was available to certainly to people both in individual households as well as businesses and large corporates. And it was available to high-risk assets, which is what caused the equity and credit markets to start flaring in March. I know you didn't ask me about that, but it is the elephant in the room, so thought I'll mention that. So it's been different this time. Money is getting there, but it's still very early days, and it will take a while for the money to get to work because, as Michael very lucidly mentioned, there is the shutdown is causing its own issues in terms of demand creation and the rest.
So thank you, Amit. This is super helpful. The contrast between what you saw as a banker in 2008 versus what you see now. the fiscal policy, the monetary policy seems a lot more responsive, a lot quicker. And we have seen this in the equity markets, at least. The markets rebounded, it lost like 30%, it's bounced back. Are the markets too frothy? I mean, it seems like we have responded to yesterday's crisis, and the full impact of the new crisis that's unfolding is yet to be seen. And is there any concern that, we're using up all our ammunition? If you think about the Trump administration and the fiscal policy, well before COVID, they had already had tax cuts. And so the fiscal policy was there they said, to stretch the period of economic expansion that we had. And now we have, on top of that, additional fiscal, I'm told not to call it a stimulus, but fiscal help certainly from the government, and also very accommodative monetary policy. If the unemployment stays this way for a foreseeable future because of the way the virus spreads in the society, what tools are left for the can we keep doing more of this? At some point, inflation going to rear its ugly head? Professor Klein?
That's a very good point. I have an account-of-fact memo with Maurice Obstfeld, who is former chief economist at the IMF, that we published a few weeks ago. It looks like we're on track for the debt to GDP ratio to exceed 100%, of rate we haven't seen, or a level we haven't seen since immediately after World War II. So at this point, it seems really important to support the economy and not to focus too much on what the debt to GDP ratio is. Okay. After World War II, the debt to GDP ratio came down because one thing was that interest rates were relatively low at that time, partly because of financial repression, but also because the primary surpluses or the primary deficits were small. So we were able to bring the debt to GDP ratio down. But just as you wouldn't suggest sort of in 1943, cutting the debt to GDP ratio by, foregoing the war effort, I think it would be a terrible mistake at this point to try to sort of worry and focus on the debt to GDP ratio and ignore the tremendous human cost that this is having. The debt to GDP ratio will be brought down when we, hopefully enter better and more normal times. It could be through a combination of inflation, which would help bring it down, tax increases, which are probably necessary. The Tax Cut and Jobs Act, which was passed in December of 2017, was regressive, and it seems like there's pushback against that now. So there'll be ways to bring that down, but I don't think that should be a focus of policy at this moment.
Okay, thank you. That's helpful. Let me now go to Kaushik. So the contrast between developed countries and emerging markets, if some crisis originates in developed countries, it seems to hurt the emerging markets. If it starts in the emerging markets, still seems to hurt the emerging markets. So it seems like that's the constant, that emerging markets are always hurt. What do you expect would happen in terms of fiscal policy and monetary policy in the emerging markets? Are they out of ammunition at this stage?
No, see, again, it's emerging markets is hard to call the whole category a homogeneous block. I mean, I think there's a lot of variation within emerging markets. But I think if you look at Asian markets, for instance, most of them actually have enough policy tools at their disposal, whether you look at it from a monetary standpoint or fiscal. I think they do have room. There are countries obviously within Asia as well who have limited headroom from a fiscal standpoint because of rating constraints. But by and large, I think countries do have options available. Then you look at countries in, some countries in Latin America and Eastern Europe, they too actually have reasonable options available, both from a policy standpoint. I think when we look at the weaker credits, I mean, I'm talking of countries which are rated lower obviously sub-investment grade, but even within that, the lower sub-investment grade categories, they have limited options. I mean, I think they have, obviously they can do domestic policies to support them, but I think really for them, it's a financing issue. It's a financing challenge. And for that, they can do stuff domestically to shore up their economy, provide degrees of support. But at the end of the day, they need access to international capital. They need access to international infrastructure financing. And that's going to be tough at this time. I think that's really the biggest challenge, because they've faced such an important or such a big shock at this point that's literally derailed 2 or 3 years of external financing for them. And that could mean everything in terms of debt repayment. A lot of countries obviously have talked about debt moratorium. They're talking with multilateral agencies in trying to resolve that. So I think we will see how that works out. But I think countries by and large in emerging markets, especially the larger ones, have reasonable amount of flexibility in terms of policy tools. Now, one thing I would say is, as Professor Klein mentioned, I think this, this was needed. I think we definitely needed the support that came in from the Fed. It was very timely. It was large. We don't really know what would have happened in the absence of this. So I think from that standpoint, it's very important. But the debate that was taking place before Donald Trump became US president amongst major central banks around the world is about ineffectiveness of monetary policy. I think we'd had low interest rates for a very long period of time. Inflation was very low, and obviously, understandably, policy was fairly accommodative, but it was starting to lose effectiveness. And I think there was a need for fiscal policy to come in and sort of support what we were seeing on the monetary side. And I think we did get that. Starting with Donald Trump, we saw that, some amount in Europe. We saw that in other countries in emerging markets as well. Now, of course, we have a situation where we need both. We need fiscal to complement what we are seeing on the monetary side. The monetary side has definitely provided support. Arguably, it will, exaggerate this social divide that we already have between the haves and the have-nots, the wealthy and the not so wealthy. But I think fiscal is ultimately needed to provide jobs, and sort of targeted spending needs to be done both in emerging markets as well as developed markets to sort of move to the next leg in trying to provide jobs and ensure that we have a more sustained recovery in place.
Okay, thank you. That's super helpful. I mean, I do worry about the weak emerging markets with weak credit ratings and whether they'll get crowded out. But again, I want to put on the hat of a lender here, Amit. Is this a good time to be a lender? I mean, what's the upside if you are lending? I'm looking at this and saying interest rates are low. The debt to GDP ratios are all-time high. I don't see sort of the post-war reconstruction efforts that's going to lead to growth. I don't know where the optimism of the growth is going to come from. And so as a lender, I'm looking at this and saying I might have more credit risk here, and the upside isn't that large to me. And we'll talk about fixed rate versus variable rate loans later, but just at a broad level, what's the upside here for a lender?
Yeah, no, very good point. And to add to the list of woes for lenders, in some time and in some countries, you might have to pay the borrower to take money. The negative interest rates are there in a few countries, and I believe are going to be set in, and we'll just have to get used to them. I imagine getting paid to take some money off your bank. It'll be having been a banker for 25 years, I can smile because I'm no longer a banker. But yes, indeed, the as you described it, the credit risks and just the risk-reward equation doesn't seem to be suiting lending, because of which I think it's going to be critical that, again, going back to the point of weak credits in the emerging markets, but also in developed markets, there is a little bit of sovereign risk coming in some sense, because of the very deep expansionary fiscal policies that have come. And the reason I mention that is because I think at a lender level, at a financial services lender level, banks at this stage are certainly looking for support, capital support and credit support from, or insurance from central banks and countries. And because of the imperative, and as Professor Michael and Kaushik both mentioned, it is necessary for these redistributive policies and to bail out whoever needs it. And therefore, the lending institutions are clearly looking for support, and increasingly every government program has a strong element of insurance provided. So at one level, the central banks are giving liquidity, and at the same time, they're also giving credit support to lenders, because without which it's not going to be possible for private capital to get allocated to where it needs to go. And therefore, this redistributive policy needs that as well. For the foreseeable, I guess, next year or two, that's the only way the lending markets are going to be unlocked, in my view. It's very difficult to say that, because borrowers are not even able to pay higher credit spreads or higher rates of interest. And therefore, the equations of risk and return just don't work unless the capital is taken out of the equation for banks. And that is being done effectively by central banks saying that if it is an insurance scheme, it is not going to be reflected as risk capital in a banker's books, which is what we saw in Asia in 2008 and 2009, which is what we're seeing as announcements in the US and in Europe at this time. The effective, execution of this policy needs to be seen, but I really feel there is no other way but for the smaller players and those who don't have access to capital markets. So they've kept the capital markets functioning, the credit markets are functioning reasonably well, but the actual loan markets and the banking market needs to stay open. And it's as I said, it's early days in various geographies on how effectively that's being done. So in the US, the individual consumer has got his or her $1,000 available, which hasn't required a banking mechanism so far. But whether the smaller businesses get that in time or not is critical, because otherwise bankruptcies are certainly facing us in a significant way, especially in certain sectors where it's fairly obvious that the demand has just completely fallen off the cliff.
Any perspectives on this, Professor Klein, about how should I be thinking about this if I'm a financial service institution? Should I be lending, or should I just focus on sort of the small business loans, which are completely insured by the federal government, and will that provide all the credit that the market needs?
I think, agreeing with Amit, it's a very difficult time to think about lending when there's such deep uncertainty and interest rates are very low. And also, as regards like a fixed rate loan, there could be a prospect for inflation because of the debt to GDP ratio being over 100%. And traditionally what we see is that inflation does rise, to help bring down the debt to GDP ratio. Although, having said that, it has been a puzzle to economists why inflation has stayed so low during this period of up until the end of 2019, very low unemployment. So I think we don't really understand inflation dynamics as well as we used to. The Phillips curve, the trade-off between inflation and unemployment, is becoming something of a mystery. Now, this is now a different world. We're not at a point of 3.5, 3.9% unemployment anymore. And also, some people ascribe lower inflation to globalization. We're seeing moves to shut that down. So I think that there aren't that many lessons from what happened before the crisis, the pandemic, for inflation for after the crisis. I would just mention two other things that are linked to what's been discussed. The point that Kaushik made about emerging markets, what we've also seen is a tremendous fall off in capital flows to emerging markets. I have another kind of fact memo with Megan Green, who's a columnist for the FT, and we document the huge fall off compared to the times of the global financial crisis, the taper tantrum, other episodes. So this is just also putting tremendous pressure on emerging markets. And then I think, there is a lesson from 2008 for today, and that has to do with fiscal policy. The fiscal response in 2008 was somewhat limited by politics. There was a view in the Obama administration that if they asked for too big a package, it wouldn't get through Congress. So they got $800 billion. There was debate about within the administration whether they should ask for more. They settled on a smaller amount because they thought that was what was politically feasible. And subsequently, Larry Summers, who was pressing for that, said I was wrong, that we should have pushed for more, that the tepid recovery had to do with that. Today, right now, we're seeing a similar kind of issue where the funding has to come up again before Congress. And in the last weeks, before we saw this renewed spike of COVID-19, there was a view that, well, we're sort of past the worst part, and there were forces in Congress pushing against renewed funding. We'll see what happens now that we're seeing this tremendous increase in COVID-19 in certain parts of the country, especially in red states, where there is more hesitancy about pushing for this. And one last point, a question came up about state and local finances. In the United States, municipalities and states have to run a balanced budget. They can have bond sales for sort of capital projects, but in general, they have to run a balanced budget. That's going to be a tremendous hit on them. I was just reading this morning in the newspaper that the National League of Cities did a survey, and 3/4 of the cities they surveyed said they're going to face severe budgetary problems. They're going to have to reduce the police force, the fire force, sanitation, and so on. And so this is a place where the federal government could step in. And the question is whether or not they'd be willing to do so. And again, it comes down to politics. The fact that we're starting to see this reemergence of COVID-19 in states that are not New York and Massachusetts, but Arizona and Texas, maybe and Florida, maybe we'll start to see more of a push from the U.S. Congress for support for these states at this time as it's spreading more widely across the country.
Thank you for that perspective. Let's look a little bit to the future. I know it's very hard to forecast in these very uncertain times, but you already seen that New York and Massachusetts are leading what's happening in Texas and Arizona and Florida. You've seen what's happening in Europe seems to be leading what happened in New York and the northeast of the United States. So if we were to forecast, can we see any trends at societal level? For instance, are we going to see people moving from cities to the suburbs because cities are very dense and they want to move to the suburbs? Because as a lender, that might be interesting shifts that I want to pay attention to. Maybe there are lending opportunities for me in the suburbs. Maybe offices in downtowns need to have more space. They can't put people closely packed with each other, so they need to have larger offices. Are there any such trends that we are seeing or that we can forecast that give us some optimism for lenders for where they might be deploying their capital? I'll open it to any of the panelists who want to take this on, or any other trends that they're seeing that they would want to point out to lenders.
If I can just take a quick stab at this from what we are seeing here in Asia, and particularly in China. I think China clearly was one of the first countries to be hit by COVID. And while we have had a little bit of a mini spike in Beijing and some other places, but overall, I think he's been reasonably well contained. We are starting to see some activity come back. What we are seeing in a country like China, for instance, and you're thinking from a lending perspective, there are some obvious clear trends that are emerging, right? I mean, people have concentrated on a couple of strong economic zones, the Yangtze Delta, the Pearl River Delta, but the South Central region is now starting to emerge as a strong emerging bloc in China. So, I mean, somebody looking at a country like China, for instance, which is obviously a very large part of the global economy now, can clearly see that as an emerging segment. The other segment that you can see in a country like that, particularly in China, is consumers are going to start becoming a much more important force. It has been an investment-driven country, but like the US, like in other parts of the developed world, you are starting to see the consumer becoming a lot more important. So sectors that face the consumer are likely to benefit more. And the third aspect that you are seeing in terms of trends, and this is true for a number of countries, we can sort of talk about others as well, but the third trend that we can see with respect to China is demographics. And clearly, I think we've had population has been very strong, but the growth rate has come down over the last 20, 30 years, and now you're starting to see the population age. So China is taking policies to combat that, but artificial intelligence, things that sort of line up well with some of those areas, obviously make a lot more sense from a lender's perspective, automation and things like that. So clearly crossroads between consumption, greater automation as demographic dividends sort of need to be focused on. And there are obviously regions that will benefit more than others. And like this, I think there are trends that are clearly emerging in every country, every block of the world. We need to be looking at that. It's not all doom and gloom. I think there is going to be sectors that obviously will benefit even in the new world.
What about people working from home? I see this happening all over the world. Companies are pushing more of their employees to work from home. And some of the companies I work with, they're saying actually the productivity has been higher. And they're asking the question like, can this be a more permanent solution? So one piece of this is, should more of my employees work from home? And the second piece of this is, if they can work from home and be more productive than I would have guessed, do they have to be local? Could they be anywhere in the world? So any forecasts on what we're likely to see in terms of where employees are likely to be located?
There's a famous American baseball player, Yogi Berra, who said, forecasting is difficult, especially about the future. Yeah, so I would, be a little hesitant to offer too many ideas about what would happen, but I think your point, Vijay, is very well taken. In my own sector, in education, there had been talk, for example, for a long time about MOOCs, massive online courses, and it never really took off. And I think part of the reason was there's no demonstration. People didn't want to have to learn. Professors didn't want to have to learn the technology. But now what's happened is that everybody had to learn the technology. Everybody is seeing sort of what you can do with it. So there's a very important ways in which the classroom experience is not replicated over Zoom. On the other hand, it's working a lot better than people thought. And I'm sure that this example has analogous outcomes in other places as well. So I would be worried about commercial real estate, for example, both because of the fact that now it seems people can do things at distance, but in the shorter medium term, because people aren't going to be going in, and people are worried about that. And I think also one interesting thing might be whether or not people in other countries, given this rise in against immigration, if we're going to see more distance work from people who can't come into, say, the United States, which is an example where under this administration, immigration policies have been very strict. That could change and change dramatically with a new administration. But I think this also has been a demonstration, much like what we've seen in higher education, that you can use the internet in ways in which people thought was more awkward or wouldn't work as well. So again, it's hard to predict any of this. We're, 4 months into this, but I think there have been some realizations about the utility of this kind of work and learning that people didn't recognize beforehand.
Yeah, I'm seeing this in many sectors. You're absolutely right. Education, something close to both of us. We're seeing this. I'm also seeing this in medicine, where more telemedicine. Many countries have given a regulatory approval for telemedicine because they don't have a choice. But if this works out well, or if they identify which pieces of this work well, it might stay longer even after this COVID crisis blows over. So they will be, it's very hard now to know which of these trends are going to continue, but there might be many of these that continue. So there might be some pockets of opportunity, but there are also very clearly some concerns like hospitality sector, the airlines. You're looking at this and saying, I don't want to be lending to a hotel. I don't want to be lending to an airline today. I take your warning about forecasting about the future, but that's the fun part. So I'm going to go to Amit and Kaushik to see if you want to hazard a guess of what.
You might want to make sure first that this isn't being recorded, so we can, have this shown to us later and how wrong we were.
Well,
Can we suspend the recording at this point?
I'll start with a disclaimer. I'll talk about the new paradigm, and at the moment you say that, it is a disclaimer because it doesn't exist. But I think some things seem to be clear, and I agree totally with both Michael and Kaushik on that. One that's seeming evident is the adoption of technology and the pace at which it has happened because of a mandatory nature in the last 15 weeks. But that's clearly here to stay. It's been going on for 20 years, but I think the last 2020 is a complete milestone year in terms of having that adapted. And as you said, medical innovation, technological innovation, but also social adaptation. We've seen that's been the most important cure or fight back against this virus. So I think in all respects, social and technological innovation is very much here to both stay and be valued. Going back to why the NASDAQ has bounced back 55%, is because it's valuing and putting a monetary value to social, to innovation in that respect. And the other thing that to me is clear is exactly what Kaushik mentioned earlier, is about, and I think just a bit broader, Asia versus the West, or emerging markets versus developed markets. The consumer leverage or the consumption story that has been a story for the West for the last 50 odd years has been beginning, and China had been flipping from investment-led to consumption-led on a macro basis for the last 10 years. But I think that is something that is going to play out very well, because it's ironic I say that today, but household balance sheets are in Asia are probably in a better place than those otherwise, because they're not leveraged. So as we build back, into the new world, I think the ability to have bigger consumption and an appetite for that, whether it be East Asia or it be India, is going to be much higher. So that's another trend I see. And demographics will play a big role there, because per capita, slight increase in per capita consumption can be a huge, addition to the overall GDP. So I see that as a trend as well. Asia taking its place. It might take a century for it to happen, but I see the trend pretty firmly being established in the last few months.
Okay, so maybe we should.
On the other side of that, it could be that, in the wake of the Great Depression, the lesson was be really careful with your money. So I remember my grandmother and my mother, who lived through the Great Depression and, were not at all well off. They were always very frugal as a consequence of that. So in the same way, especially in the United States, where the rate of personal saving had been quite low, this might be a turning point where people decide, maybe I shouldn't buy that boat. Maybe I should not take that expensive vacation. I have to be more careful, because the future could be much more precarious than what was thought before the onset of the pandemic.
Indeed, I completely agree with you, Michael, that's been Asia's philosophy. I think the US Great Depression taught Asia for 50 years to be frugal. And I just think, again, with the demographics where the young, the age demographics are also on Asia's side, There may be, but you're right. It's difficult to call, but my gut feel is that the outlook will be much more positive in Asia, certainly, and the US may go into a bit of a mentality of
Right.
save. Yeah.
None of these things are monocausal, and I would agree demographics is really important, but there are things working sort of in opposite directions as well.
Indeed.
And so, it's hard to tell how it's all going to play out ultimately.
The only thing I very quickly, just very quickly, I wanted to add, I did actually feel that even after the global financial crisis, savings rate in the US, personal savings rate in the US was going to go up. It went up for a little bit, and then I think it was back to what it was earlier. So I think it depends on what sort of lasting psyche people carry from this, and I think how long that lasts. And I think I do think that will change. I don't think this is probably as deep as the Great Depression, as Michael also very clearly outlined. But I think there is a chance that at least for the next few years we will see a temporary lift up of the sort of savings rate, and then we'll see. It depends on how long this problem lasts.
Okay, thank you, everyone. I want to go to the questions that we've been getting from the participants. So this one says, would the panelists agree that the greater unemployment rate or resultant lower cost of labor will decrease the demand for automation solutions? I agree the demand for work from home solutions tech will increase. But what about automation? What's your forecast?
Again, I think in this case, you can't look at this as a monocausal thing. There is debate in economics and uncertainty in economics about what has caused wage stagnation. So some of the candidates are in fact automation, but also issues like globalization, the loss of union power, monopsony power, where, in especially more isolated places, you have a small number of firms. And so all of these things can be affected by what's been going on over the last 4 months. For example, if globalization is cut, then we're going to see in countries like the United States, higher demand for lower skilled workers. So these things all cut in many ways. To say that cheaper labor now would lead to greater automation, we've already seen a huge increase in automation. The only people left at auto plants are sort of janitors, or steel mills rather, are like the janitors, whereas this used to be a source of good middle class jobs. So I think it's, there's a lot of things going on, and we want to be careful about giving too much weight to any one particular factor when all of these things have many different sources of outcomes.
Okay.
Yeah, no, I couldn't agree more with the professor on that. It is, remember the Industrial Revolution, and then, so they are going to be, it's going to be brutal, it's going to be painful, but there are going to be winners and losers. I think efficiency will probably trump without, the fact that there is an inefficient but cheaper way of doing it in the short run. So I think automation will not really take a step back, but it's very difficult to make a generalizing statement on that. The other thing I would say is that given just the power of, and there was another question around that about analytics and the power to compute, it is going to be just that much more efficient to use computer models to do anything, because rather than spray it in all directions and hope it reaches. So for lending, certainly, using the credit models that will clearly are being developed because of the amount of data which is available on individuals is so robust and so easy to analyze and to churn out, that all of these is a, I think this one is not going to stop. This is a juggernaut which is here to stay in terms of the use of technology and automation in a lot of ways, yeah. But Michael is right. It's going to cut in different ways depending on geography, sectors, and all the rest of it.
Kaushik, you have a point of view on this, on automation and use of technology?
No, I mean, I think that's here to stay. I think we will probably make further progress on the automation front. I think the human-to-human contact will probably, at least next few years, is going to be scrutinized, and I think you will see more focus on the automation front. So I think even in emerging markets, that's clearly a focus where labor is definitely a lot cheaper than is the case in developed markets. So I don't really have any issues with what's been said so far.
So let me summarize what they're saying. They're saying that the trend for automation, AI, is likely to continue. It probably wasn't driven in the first place about replacing labor. So the price of labor can move up or down based on different factors: globalization, less immigration, more unemployment. Many go in opposite directions. But this juggernaut of using more automation, more, we see predictive modeling, not just in credit lending, but also even in consumer marketing. Amazon has such finely tuned models that tell you exactly what price to offer which customer and what other product to suggest. So those things are secular trends that probably continue, and the way it works might change as a result of this crisis, but the overall trend is not going to change. And one place that I see when people are working more from home, the need to digitize a lot of the documents, or documents that are born digital, it seems to be going up. That makes it easier to share documents from the office to employees that are working in remote locations. But the same thing might now extend to customers. So if you're a bank, all the forms that are coming in are digital. Interactions with the regulators is going to be digital, because in the COVID world, that just makes it easier. So many of these trends will probably continue. Let me see if there's any other question that we have here from the panelists, from the participants. So Jay Kumar has this question: if there's a trend towards prudence at the individual, family, or societal level, then does that mean consumption-led growth model may not work? What would then drive growth in the coming years? And here I think the panelists are saying there might be a difference between the US and Asian markets, and even within emerging markets, there might be differences from one market to another. Any thoughts on that, Kaushik, whether it will be consumer-led or it will be government-led spending?
See, I think initially it will have to be government-led, because government will have to pave the way for, or at least provide the supportive environment for people to then come out and consume. But once we get some stabilization on this virus situation, I think the pent-up consumption demand will pick up, and I think that will probably be a much bigger driver for the economies from a medium-term perspective. The government will probably need to take a near-term step. I think from a medium-term perspective, from a slightly longer-term perspective, countries like India, which are fairly domestically focused and consumption-oriented already, I think probably have less of a boost that's going to come from the consumption side. They're obviously, on a delta basis, we're not going to see it as much. But countries like China, which have been, and a lot of parts of Asia, which have been heavily export-focused, heavily investment-driven, will see a much bigger transition to the consumption side. And these are massive GDPs, right? We are talking about. I mean, in terms of contribution to global GDP, China plus ASEAN plus South Asia, on a sort of delta basis, is contributing 66% of contribution to global GDP. Now, if that is where the needle is going to shift from a global GDP standpoint, that's a very important block.
And different countries have been affected differently by this COVID crisis. Some have been much better able to control this. So excellent. So thank you all, to all the participants. Let me leave this there in terms of answering the participants' questions, and turn it over to Arindam now.
Thanks a lot, Vijay, and thank you, panelists. I think we're almost out of time. I just, I keep saying that death, taxes, and technology are the only permanents in life. Listening to this panel, I think we're going to dodge the taxes, and given the vaccine, we might be able to dodge death. So technology is really permanent. On that very optimistic note, thanks a lot again. For our attendees, we're just going to publish a quick survey on the screen. If you could take literally 30 seconds to punch in your answers. We're going to give everybody 30 seconds if you could punch in your answers, and then we're going to bring this panel discussion to a close. Thank you. That's excellent. Thanks a lot again. One final word. The next one in the series is going to be on the 16th of July, and we're going to focus on digitalytics being used and the rise of intelligent digital. We are lining up a very high-powered panel again with a mix from people from academia and from industry. So I look forward to all of you joining us back in about a month. Thank you again, and have a great rest of your day.
Thank you.
Thank you.
Thanks.
Thank you.